All right, so today we are going to talk about trading psychology and emotional discipline, mastering the mind behind the charts. The vast majority of traders are not unsuccessful because their strategy is terrible. They're unsuccessful generally because they either can't manage risk or because they let their emotions take control, which causes them to not be able to manage risk. And there are several driving forces behind that. We're going to try to address several of those factors today. I hope that this is able to bring some clarity to you. Most of this information is pulled from three books. One is Trading in the Zone by Mark Douglas. Another one is The Mental Game of Trading by Jared Tendler. And the third is The Best Loser Wins by Tom Hugard. There are a number of great additional books that are out there. I'm constantly looking for more, but those are the three that it's largely built around that we'll be covering today. All right. So, why psychology matters in trading. 80% of trading success is psychological discipline. That is a figure that comes from Trading in the Zone by Mark Douglas. Uh, most most people fail when it comes to trading because they lack psychological discipline. Now, the reason that you lack psychological discipline is because there are several factors. We can get into some of those later, but a couple of them are going to be the chemicals that your brain produces when you're in a trade. We're gonna cover those in depth a little bit later, but it's generally any strategy can be profitable. Any strategy can. I think you've proven that any people have over time proven that any strategy can be successful in and of itself if the person pushing the button can master themselves. So your strategy can be perfect, but your emotions will test it every single day. You can have a strategy with a 90+% win rate where 90% of the days you win, you end up green. But then that one red day can blow your whole account. That is because you're letting your emotions take over. You're unable to take a loss. You're not able to live with the fact that you have a red day. And so what that causes is a giant spiral. Your brain starts to produce several chemicals. One, when you click the buttons, there's that dopamine reward. Two, when the trade starts to go against you, cortisol floods your system, and when you take a loss, that cortisol can take over, and it can actually shut off the logical part of your brain that will allow you to think, okay, one loss is okay. My strategy allows for several losses in a row. My risk management allows for several losses in a row before I blow my account. But most people can't seem to manage that because they feel like they have to make the money back right away. You need to accept that losses are inevitable. How you respond to them will define your career as a trader. Every strategy is going to have losses. If you say you have a 50% win rate, it's a coin flip, but you're using the same strategy over and over again. You flip a coin, and your odds of taking four losses in a row are only 6% if you have a 50% win rate. That's pretty low. That means you have a really high success rate, even with a 50% win rate. You should. The problem is the market doesn't care about your feelings. Trade your plan, not your mood. We tend to think that I've got to make my money back. I've got to make my money back when we take a loss, rather than trusting to take an entry when our strategy tells us to take an entry. We feel like, well, if I'm wrong now, I must immediately have to switch to the other side. Then you take the opposite position and you get smacked. And so choppy days will tend to absolutely blow you up because you're not really waiting for a trigger. You're just having a hard time accepting that you might be wrong. The goal of a successful trader is to make the best trades. Money should be secondary. If you focus on the process, the results will take care of themselves. All right, strategy is your guardrail. One, you should have a rules based entry system, and that's really going to be the biggest help to your psychology and emotions when it comes to trading. A lot of people really struggle with the psychological aspect. They struggle with fear. They struggle with whether it's fear of missing out, like FOMO, or fear of losing. They'll struggle with it because they don't have a rules based entry system. It can be as simple as 9 and 21 EMA cross when they cross and the candle closes on the side of the 9 EMA. Then you take that position, whether it's longs or shorts. It can be, I'm going to trade inverse fair value gaps after a sweep of liquidity. It can be, I'm going to trade support and resistance, supply and demand. Whatever it is, most of the time, the people fail because they don't have a rules-based system. So define your entry criteria before the session. You sit down before the session starts. You take a look at what you expect price to do. If this does this, then I'll do that. But if it does that, then I'll do this. Plan it out before the session. Know what you're going to do. If price doesn't do what you expect it to do, then you sit on your hands and you wait until it does something that you expect. Know your exit, both your target and your stop loss in advance. Always know exactly where you're going to take profit, know where your stop loss is going to be, and make sure your stop loss is somewhere where the trade is invalidated if it gets to that point. Don't just find some area based on I don't want to lose more than X, so I'm going to put my stop here where that amount is. If that's the case, you need to size down and put your stop to where the trade is invalidated. If price gets to that area, it's invalidated, and now I'm just going to sit and wait for my next setup to present itself. 3, use a checklist. No check, no trade. For my strategy, I have several different things that I'm looking for personally. One is an SMT. No SMT, I don't take the trade. If you don't have a checklist, if you don't have a rules-based system that says these are the things that must happen before I get in a trade, that's part of where your fear is coming from. And last, on a rules-based system, backtest and trust the data, not your gut. A lot of people think, well, the market can't keep going up. It's got to go down at some point, so I'm going to take a short here. It can't keep going down. It's got to pop at some point, so I'm going to take a long here. The market can remain illogical longer than you can remain liquid. I can't remember exactly who said that. It's in Mark Douglas's book, Trading in the Zone, for sure. But that's a fact. You can't trust your gut. You've got to make sure that you're looking at exactly what your back testing and your forward testing are telling you. The things that you learn in front of the charts are far more important than what your gut is telling you. Without rules, you'll have impulse entries driven by FOMO. You'll see price start to take off, and you'll chase it only to get caught in a retracement and take a heavy loss. You'll move stops to give it more room. If you are putting your stop where the trade is already invalidated, you don't need to give it more room. That means that that trade is invalidated at that point, and you need to give yourself an opportunity to look for another setup. 3, you'll revenge trade after a loss. I've got to make it back. I've got to make it back. And more often than not, you're going to blow your account. And last but not least, you'll get inconsistent results, meaning you have no edge to measure. Inconsistent results are really going to give you a problem because that's going to give you a lot of fear when you approach the charts. Because some days you have great days and then other days you won't have great days. But you won't really know why because you're only trading with your gut and you're not trading with any kind of rules or system. And what will end up happening is you'll start to spiral out of control a little bit when it starts to move against you a little bit. A strategy removes you from the equation. That's the entire point of having one. You want to make sure that you're removing as much emotion from the process as possible, that you're replacing it or instilling logic into the whole process rather than relying on your gut. All right, risk management and daily loss limits. This is going to be super key to helping you ensure that you keep your accounts, and 2, that you don't let your emotions get out of control, and it'll really help you have some longevity to your accounts. You don't have to blow accounts every day, every week, every month. You really can hang on to them for a long time, but it's going to require you to have some risk management and daily loss limits. You want to have a max daily loss, set a hard dollar amount that you will not exceed. When you hit it, you're done for the day, no exceptions. Most trading platforms will allow you now to set a max daily loss limit. TopStepX will allow for that. Tradeovate will allow for that. I know that in Panovix, I've created some risk management tools that will allow for that. So set that in there where it locks you out. Once you lose a certain amount for the day, it locks you out. You can't trade anymore and you're done. That will save your accounts, because what ends up happening, say you, like in most cases, used to be with TopStep, if you had a 50K account, you started off with $2,000 in drawdown, which you still do for now, but they had a $1,000 daily loss limit. Those daily loss limits really helped people keep their accounts. And so prop firms really did away with them. They did away with daily loss limits because they're like, well, people are going to blow more accounts if they don't have a daily loss limit. Their emotions are going to spiral out of control. Prop firms make more money because you're buying more resets, you're buying more accounts. Do yourself a favor. Yes, it might mean that you're going to add a day or two to your evals, but at the end of the day, it's going to work out for you in the long run. It might take another day or two for you to get a payout. That's fine. You're much better off taking a day or two longer to get a payout than a week plus by the time you got to restart an eval and then build up the winning days to qualify for a payout. You're better just to wait and let it take care of itself. Wait for a good setup, absorb your max daily loss, and move on. Position sizing is incredibly important. Risk a fixed percentage per trade. This will keep any single loss from damaging your account or your psychology. I talked about this a little bit earlier. If you have a 50% win rate, it means you only have a 4% chance, a 6% chance of taking 4 losses in a row. So you have a 94% chance of winning your 4th trade if you lost the first 3. So you need to make sure that your position sizing will allow you to take a few losses in a row. If you take 4 losses in a row and you have any kind of decent strategy that's 50% or higher, then you're going to be, you're going to be starting over. You're going to have to go, back to the drawing board. Is it just a statistical anomaly that happened? Were you taking bad trades? Were you not waiting for good setups? Were you not being patient? Kind of evaluate, journal and evaluate and figure out what went wrong. And sometimes it just happens, and that's okay. You just have to learn to accept it and move on. But if you have a fixed position sizing, it's going to keep you in the game for a lot longer time period than if you say, well, I feel really confident about this trade, so I'm going to size heavier, and then it absolutely smacks you and blows your account. That's going to cause a lot more stress. It's going to mess up your psychology. Once you gain confidence and once you have some longevity to your accounts and you've taken some payouts, then by all means. But in periods, especially when you're struggling, you need to have fixed risk amount. So on a 50K account, you do not really want to be risking more than $500. 2% would mean you'd be risking $1,000 on a trade, which, if you've got a great history and you've got a really good win rate and you know exactly what you're doing, then, by all means. But personally, I would say you want to risk between $250 to $500 per trade on a 50K account. And then walk away rule. After 2 to 3 consecutive losses, stop trading, even if you haven't hit your max daily loss limit. Just stop trading. Emotional capital depletes faster than account capital. You're going to suffer from decision fatigue. You're going to need to take a break. You're going to need to walk away. Maybe if you took 2 losses in the AM session, you take a break, you lock your accounts for a few hours. Come back for the afternoon session, see if there's a setup. Or if you can't trust yourself to do that, just lock out for the day and be done. Walk away, save your account, come back the next day, try it again. And risk management is not optional. It's the foundation of longevity. It is absolutely essential to ensuring you have success long term. No strategy wins 100% of the time. I know people will try to flaunt these strategies and win rates. They're like, oh, I win X amount of times. But here's the reality of win rates over time. This is not for a week. This is long, 6 to 12 month time frame. The average profitable trader wins 55% of their trades. If the average profitable trader wins 55% of their trades, that means you need to be able to manage risk in a way that will allow you to take a few consecutive losses. A good trader wins 60% of the time, and an elite trader wins 65% of the time. So a loss taken per your rules is still a good trade. Sometimes you're going to have your system, everything's going to present itself. You're going to go check, check, check. Yep, this is a good trade, and you're still going to lose. That is okay, because no strategy wins 100% of the time. You're still going to take a loss. And if you're managing your risk and you know exactly what your win rate is over time, taking a loss when you've followed all your rules is still okay. You shouldn't beat yourself up. It just is what it is. Sometimes you're going to get in, everything's going to check itself, and you're going to get a Trump tweet right to the face, and a news candle is going to smoke your position. It happens, man. That's the reality of trading in today's environment. Your edge plays out over 50 to 100 trades, not just one. Just because you take one loss Doesn't mean anything. This is why it's important to journal. You need to make sure that you see, okay, here are the confluences that presented themselves. I took the trade at won. Here are the confluences that presented themselves. I took the trade at lost. Over time, you'll start to see exactly how your edge plays out, how it works out, what your win rate is, and it will allow you to do some really, really good introspection into whether you're following your system or not. But this is why it's important to have a rules-based entry system. If you don't have a rules-based entry system, you don't have an edge. Think in probabilities, not certainties. If you're playing blackjack, even if you're a card counter, you're not expecting to win every hand. You're playing probabilities. You're not playing certainties. If you're card counting, you're plus minus, whatever. You think your odds based on a certain plus minus are going to be X. They're not going to be certain. It's not going to be 100%. The house could still turn 21 and you could still lose. It happens. Journal every loss. What can you learn? There's no reason not to journal your losses. There are a number of tools out there. One is Panovix, where you can start for free for 30 days. You can journal your loss. You can figure out what you need to learn. What do I need to learn about myself? What do I need to learn about my strategy? What seems to work and what not work? More frequently than not, the reason people lack success in this is because they try to rush. They got to have money right now. I got to have it, got to have it, got to have it. And the more you rush and the more you push, you're not allowing yourself to read the market. You're trying to get yourself to predict the market. We don't want to be in that kind of situation. We want to be where we're reacting to what the market is doing and taking the opportunities that present themselves rather than putting ourselves in a position to try to predict bounces and rejections. And you have to separate your self-worth from your P&L. Just because you take a loss does not mean you're a bad person. It doesn't mean you're stupid. It doesn't mean you're dumb. It doesn't mean you can't learn. It doesn't mean you can't do this. You have to pull yourself away from equating yourself personally to your P&L. Losses are tuition. You're going to pay them. You're going to learn from them. You're going to move on. It's part of it. It's market tuition. Just how it goes. Common emotional triggers. What you'll notice is that two of them have the word fear in them. FOMO, chasing move that you missed. The market will give you another setup. It always does. People will think, people will think that because they see they get a lot of consolidation, they'll suddenly see this massive candle out of nowhere. Oh, I got to get in. I don't want to miss the move. This might be the only chance I get today. Yeah, it might be. It's okay to not take it, because more often than not, you're going to chase, you're going to get a pullback, and you're going to get smoked. It's you're going to either have to move your stop to break even really quick to manage risk, where you don't get anything out of it anyway, and now you just had a bunch of stress for no reason, or you're going to get in late, price is going to pull back, it's going to pull back too far, and you're going to take a loss, and then it's going to bounce, and it's going to give you the trade you really wanted anyway, and you're going to have missed out. So FOMO, don't fall victim to it. Revenge is when you're trying to get back what the market took, and this is ego, not a strategy. This is the inability to accept a loss. It's the inability to accept a red day. And a lot more people suffer from it than you think would be possible. I know a lot of you see on social media, a lot of people, I will all have all green days. I don't ever have red days, this and that. There are a lot of liars. There are a lot of reasons why that can happen. Don't buy into it. Focus on you. Understand that there's no sense in having ego, because it's not going to work for you long term. Overconfidence really is a big one. A lot of times people blow their accounts after they take payouts because they're on a good winning streak, and so they'll size up. And then as soon as you do that, the market has a way of kind of bringing you back to reality and has a way of humbling you. So try to avoid overconfidence. Try to recognize it when it presents itself. Say, man, I'm feeling a little overconfident. I should probably take the day off and give myself a chance to come back better. I would personally recommend for most of you, if you take a payout, you're probably a little overconfident, you should probably take the next day off. And then fear is when you hesitate on valid setups after a loss. So you take a loss, and it met all your rules, it met all the criteria you're looking for, you still took a loss. Guys, it's going to happen. Like I said, no strategy wins 100% of the time. Take the loss and trust the process. Do not allow yourself to just fall victim to not trusting the process. The whole idea behind this is to be consistent because consistency compounds. Trust the process, absorb the loss, understand that, like in my case, I've got a decent win rate and I've got a 3.2 to 1 risk reward ratio. So I know for every one loss I take, I'm going to win 3.2% the next time, or 3.2 times that loss the next time. So if I take a loss and it's $500, if my next trade's a win, I just made $1,500. I can take 3 losses in a row, and my next trade, if it's a win, I'm back at break even. So there's no sense in being afraid. Trust the process. Understand that, yes, these are the setups that I'm looking for. Here's exactly how I want to trade. And trust the process over time. Recognize the trigger, the emotional trigger, name it, and then do nothing. There are a lot of different ways you can deal with each particular one, and there are far more emotions. If you read The Mental Game of Trading by Jared Tendler, he goes through each one, and he goes through with different ways you can deal with it. So I would highly recommend that book. Build a pre-session routine. Review your rules. Read your trading plan every single day. So understand exactly what setup you're looking for. Make sure you write your plan down, and make sure you're ready before the market opens every day. Mark key levels. Identify your areas of interest before the session opens. For me personally, that's previous day's high and low, session high and low, so Asia high and low, London high and low. Midnight open is going to be a big one. If there was news at 8:30 a.m., I'm going to mark the Newswick high and the Newswick low. And then when the market opens, I'm going to be ready to go. Set your limits before the market opens. Know exactly, okay, here are the trades I'm looking to take, the max number. Here's the max loss I'm willing to take for the day. And for a lot of you, it wouldn't hurt to have a daily max that you make, because a lot of you tend to overtrade. Now, if you make just a ton off of one trade, then by all means, keep it. But for a lot of you, you'll make a lot, and then you want to keep trading because greed takes over, and you feel like you need to take more, and then you end up with less than what you had. Write all that down ahead of time. Put it on a Post-it note. Stick it to your monitor. Whatever you got to do to keep it in front of you, but make sure that you know exactly what those rules are before you start. Check your state before the market opens. Are you tired? Are you stressed? Are you distracted? Do you have a lot going on in your life? Are you trying to force trades for any particular reason? If you're feeling out of sorts, you're better off to not trade that day than to try to force yourself into a situation where you're taking trades that you don't need to take. And last, execute and journal. Trade your plan, then document it. Every trade, win or loss. And you'll realize over time, I know people will say that journaling is a waste of time, but when you're really trying to get yourself on the path to profitability, journaling is important. Once you're profitable, you can kind of journal as needed, but until you're profitable, you should journal every day. Routine creates consistency. Consistency creates confidence, and consistency compounds. That confidence is going to really be what pushes you through to the next level. Here's the key takeaways. Your strategy is your guardrail. You should follow it without exception. Quit strategy hopping. Quit trading multiple strategies within a given day. Find a strategy and stick with it for at least a month, preferably longer. You want to try a strategy out over at least 20 trades, before you try something else. Risk management keeps you in the game long enough to win. You have to manage risk. You have to make sure that you set targets or maximums that you're willing to lose in a given day, and then move on. Losses are the cost of doing business. Manage them. Don't fear them. They're going to happen. No strategy wins 100% of the time. Emotional awareness is a skill. You have to build it like any other. It's just like going to the gym. Just because you started lifting weights one day doesn't mean you're going to have 25-inch biceps. It's just not going to happen. You have to build it. So you're not going to go to the gym your first day and start curling 100-pound dumbbells in each arm. It's not going to happen on your first day. When you're first starting out trading, your emotions are going to be the same way. They're going to kind of take over. Your heart rate's going to speed up when you get into a trade. You're going to be afraid. Dopamine's going to hit when you get your first win. All that's going to happen. You have to learn how to manage it just like anything else. And routine and journaling are your competitive edge. The more you can stay in a routine, the more you can have consistency, the more you can have rules and understand exactly what you're looking for, the better you're going to be over time. That's going to be your edge, your competitive edge in the market. That's what's going to be get you to qualify for payouts. That's what's going to make you successful long term. So I hope you all have a great day. Appreciate your time, and I will catch you next time.